Hey, I'm Darren with Arbitrage Trade, and it's time for Deep Dive with Daniel. That's Daniel Hopwood, and you can see he's even got his cute little graphic now, a little fancy graphic in the middle.
We're
Where's
moving
my
up in the world,
graphic?
Darren. We're
Gosh,
moving
I
up in
don't.
the world.
Yeah, but where's my graphic? I don't have one. I guess it's because I don't come up with subjects like navigating the waters of initial public offerings, a comprehensive guide.
That's why they give me the titles.
I know. So you can do the titles. Now, but we're going to talk about IPOs, which we've covered a little bit this week in other forms and formats. And I think that was all because of Reddit and how it did. We were kind of just spurred on. It's like, you know what? Some people may not know about IPOs and what they're about and even what it stands for. So we're going to cover it one more time here, but this is going to be the deepest dive into the IPOs. And I promise we won't cover it next week. Uh, Daniel, give us the basics of what an IPO is.
Yeah, so IPO stands for initial public offering, and it's when a company goes from privately held, so you can think of it as employees, investors, and founders own the shares of the company, to it being available to everybody, people like us, large institutions that only own public stocks. And it essentially is a way for companies often to either raise money or kind of take themselves to the next level of having that public scrutiny to go from Facebook the startup to Facebook the behemoth that it is now.
So from public or from private to public, so that we all can jump in and make some money,
or gamble on it.
Yeah, or lose money on it. That's right.
Yeah.
It goes both ways. So you say we should go public, basically to raise money for what we're doing, and maybe we're not making enough money before. Hopefully, they've done a lot of homework before they get to this point of releasing an IPO. So that it's not a failure right off the bat and everybody starts taking profit. And then it's nothing but a money making machine for those that got in early. So just recap what happened with Reddit early this week.
Yeah, so it went public. I believe it was around $50. And, on that first day, it was up 50%. 3 days later, they had options available and went up to about, I don't know, I think it was like $75 or something. It's come back down a little bit. But, they essentially went public to raise money. I forget, they were, how many $1 billion was their valuation? Do you remember?
I don't, for some reason, and don't take me at my word, we're not financial advisors. It's, I want to say 8 or 9 billion, wasn't it? Was it?
Yeah, I think it was around eight. Yeah. And so, a company like that, at that level, they're often going to go with Goldman Sachs. They're kind of the premier tech, underwriters of IPOs and M&As.
That was their big thing, right? I mean, that's one of their big things is helping companies that are getting started, correct?
Yep. Well, once they're over the $1 billion hump, getting started.
Oh yes, there's a snob thing there about you must be over this before we will talk to you and touch.
We called it pedigree, Darren. But so, a
you are not
like
royalty
Reddit,
yet
until you IPO with Goldman. But yeah, so
right.
they would go public to raise money. It's kind of known during their IPO that they haven't turned a profit in the 20 years. They hemorrhage cash every year, and the hundreds of millions of dollars. And so the idea would be that they can sell the shares the company owns, bring in that outside capital that they raise, then they can grow the business to the point where it's profitable. And as they turn a profit, they grow. They either continue to raise in price by future guidance of potential growth, which a lot of the speculation is on their ad and selling their, I guess you would call it, platform for AI models. And hopefully, that continues to grow and the price increases. So, you own the share, you make money when you sell, or eventually they pay out a dividend to the people that hold the shares.
So when you become public, you have some things that you have to worry about. Then you might lose control of your company.
Or at least takeovers, or otherwise known as activist investing.
Activists. Oh boy, there's a whole nother blog. We need to write that down. Activist investors. We could do an hour on that one. Yes, it is actually. Talk to Disney right now.
Yeah, right.
Yeah, but you you basically can lose control of your company. You have to have a board, right? I mean, that's kind of what comes next after all that, and have outside sources come in and say this is what you should be doing with your company, i.e., the activist investors. And plus, you have a bunch of stockholders who want you to do well and have their opinions. So, and then you have regulators. It's like, well, I didn't have regulators in my face before, but now they're going to look at everything you do from the process of IPO on, right?
Yeah, you have a board of, people that own honestly a small share of the stock, but help advise the company and what to do next. You have to start filing your 10K annually, so that, people are able to read and see the financials of the business. You have to do your quarterly earnings as well, where the CEO or CFO has to get on a call and kind of talk about how things are going and how they're about to be going, which, with tech companies, can be a 50% rise or drop day, depending on those.
Well, in that case, if they think it's going to be a drop, they'll just say, we're not going to announce forward guidance this time.
But yeah, there's another one. You could be like Apple and just completely stop.
Like forever. I'm just not going to say it. So just tough.
Until things turn around.
That's right. We'll just tell
pretty shocking that they're allowed to just say like, yeah, you're not going to get to know.
It's crazy. They should be sued for that. But it's like, we're just going to tell our insiders, and then that's it. Oh, I'm sorry. There's not insider.
No, of course not.
Okay. I wouldn't say that. Just an opinion, in my opinion, not a financial advisor. So I think one of the last things you talked about was pricing. So how does that work? How did they come at 50? Was it 50 for Reddit? Somewhere around there, 45, 50. How did that come about?
Yeah, so pretty much what they do is they try to get a fair estimate of what the company's worth, and then they divide that up by the number of shares. So that's typically the market cap of the company, right? So if they say the market cap of Reddit is 8 billion and there's X amount of shares, that comes out to, they believe, would be $50 a share. Really, it's more priced on what they think the total value of the company is, and then how many shares they're going to have to put it out.
Gotcha. It's a lot simpler than it sounds.
That's a very high level, but the number of models that the investment banker analysts are, spending months at a time not sleeping on is quite complicated.
Sure. I'm sure that first hour or so, they kind of know before they come out on the market with the price, but because they spend all that time getting to a certain price before they open it up for trading. But,
I yearn for the American Psycho Patrick Bateman days when I imagine there was no Excel, that there was a lot of background math and just a whole lot of lunches going on.
To be a fly at those lunches, absolutely.
Right. To be at the lunch. They're making a lot of money and not doing the amount of work I'm sure people are doing now.
Somebody else is paying for that lunch, not me. So let's wrap this up. Some final thoughts. It seems like we're in an IPO period right now, mergers and acquisitions and IPOs, and it just seems like it kind of turned on around the start of the year, like it was almost planned. And just kind of wrap up what your thoughts are this year. Are there going to be a bunch more because of what's already happened and how well some of them have done? Is there going to be enough cash flow out there and liquidity to fund these things that they've been waiting for years to fund? I mean, how's it going to look this year?
Yeah, I think you're going to see quite a few companies IPO. You've seen a lot of these private companies, especially tech companies, take pretty large down rounds. And I think a lot of investors want to be realized with their gains that they've had. Companies like Stripe, will they go this year, next year? I don't know. But it's companies like that I think of with, rates coming in, potentially 3 cuts this year, that in the market is showing that it's still, bullish. There's no sign of it being bearish, that you're going to start seeing a lot more IPO and M&A activity. And so, this is probably the first big one of the year. And if they go, steady for the next 3 to 6 months and they don't totally tank off, which, typically IPOs, especially tech IPOs, they actually decline the first 3 years and then you see their true gains. You can look at a company like Slack before they were acquired by Salesforce. Facebook as well did the same exact thing. I think you will see, we're not back in the ZERP area, but we're going to see some ZERP mentality, I think, for a little bit.
All right, you're gonna have to break that down for people who don't know what ZIRP is.
Zero interest rate policy. It's when the
There you
Fed
go.
said money was free, so tech went flying because
That's right.
tech takes money to leverage. So when money's free, you
Yes,
borrow more
yes.
and you invest more.
And I was going to say, ask Kathy Wood. I mean, anytime you say, "Hey, you haven't done well," then she just says, "Well, it's just not time yet." So he talks about your 2 to 3 years minimum.
Yeah, well,
So
she
she
pulled a
might
bit
be
of
on the
a
5 to 10
Kramer
year
and
plan.
sold the bottom of a lot of things. So
Yeah, she did. Absolutely. But if you got the money to do that, I guess. Anyway,
hey, she makes money on the fees.
man, she does. All right. Hey, thanks for your expertise, Daniel, one more time. And look forward to have a good Easter weekend, by the way. And look forward to seeing you next week.
Catch you next week, Dan.
All right. Bye-bye.